a primer on stablecoins.
Welcome to the Deep Dive. We're the show that takes a whole stack of sources and really digs into them to pull out the key knowledge for you. Today, we're plunging into the world of stablecoins. Now, if you've ever kept an eye on cryptocurrencies, things like Bitcoin or Ethereum, you've definitely seen those dramatic price swings, right? A 10% jump or maybe a plummet in just a few hours, or, halving in value over a couple of months. It makes you stop and think, how can you actually build a reliable financial system on something that's, well, so volatile?
Yeah, and that's exactly the problem stablecoins were made to solve. They're a pretty unique kind of cryptocurrency. They're engineered specifically to maintain a stable value. Usually that means being pegged one-to-one to a real-world asset. Most often that's the US dollar.
Okay.
So think of them less like speculative assets and more like digital cash.
Yeah.
Or maybe a digital version of holding dollars. They come with all those blockchain advantages.
Okay.
Faster, more flexible global reach, and they're available 24/7.
Right. And our mission today for this deep dive is to really unpack what these stablecoins actually are. We want to explore why they've become so incredibly essential, especially in crypto and in DeFi, decentralized finance. And we'll dive deep into the different kinds out there. We'll also need to tackle those really critical questions around trust and transparency, and of course the regulations, which are changing fast. We've got a whole stack of sources here. Crypto exchanges, financial news sites, research papers to try and give you the full picture.
And it's really not just a niche topic for, hardcore crypto folks anymore. Stablecoins are already behind, over 2/3 of crypto transactions every month. That's huge. And what's really striking is seeing their impact in emerging markets, places dealing with serious currency devaluation.
Like Argentina, you meant.
Exactly like Argentina. The stablecoin transaction volume there actually beats the global average. So the reality is you might already be using them or interacting with systems built on them, maybe without even realizing it. They're becoming pretty foundational to digital finance.
Okay, so let's start right at the beginning then. What exactly is a stablecoin? And why is that stability part so crucial in this, let's face it, often wild west of crypto?
Well, what's fascinating, or maybe just essential to grasp, is those price swings we talked about with Bitcoin, going from under $5,000 to over $63,000, then boom, a 50% plunge in a few months. That kind of volatility makes even simple routine transactions incredibly risky.
Right, like buying a coffee, as you said. The price could change before the payment even goes through.
Precisely. So a stablecoin addresses that fundamental need. It's a digital asset, lives on a blockchain, but it's designed for low volatility. And it does that by pegging its price to something else, usually a fiat currency like the US dollar. So the core purpose is just to cut down that extreme volatility. It gives people a liquid, sort of safe way to hold value or trade within the crypto market. They basically merged the stability we expect from, say, the dollar with the benefits of blockchain tech. The decentralization potential, transparency, security, speed, efficiency. It fills that gap, the need for a reliable medium of exchange online in this digital economy.
So they function like a crucial bridge then, allowing people to move between volatile crypto assets and something stable without having to cash out entirely into traditional money, like a safe harbor.
Exactly. A stable harbor is a good way to put it.
Yeah.
And it's not just about holding value. They are absolutely critical as the backbone for a lot of DeFi protocols. They're used as collateral. They provide liquidity for lending and borrowing platforms. It oils the wheels of DeFi.
And the cross-border payment aspect sounds really significant too.
Oh, it is. The data we've seen suggests stablecoins can slash remittance costs by up to 60% compared to the old ways. That's especially true in places like sub-Saharan Africa, Latin America. It gives people access to stronger, more stable currencies when their local one might be shaky. That's a massive deal for financial inclusion and freedom.
Wow, yeah, 60% is huge. And the market size itself just underlines how important these have become. You said surpassing $156 billion in 2024, hit $251 billion in June 2025, and projected to hit over $1 trillion by 2035.
Yeah, the growth trajectory is just staggering. It tells you that this isn't a fringe experiment anymore.
Clearly. Okay, so given this incredible growth, their utility seems undeniable. They're obviously here to stay. But what really sets them apart from each other? Because you hinted earlier, not all stablecoins, or maybe not all stability is created equal, right? Let's dive into those different categories. How do they actually work?
Right, good question,
Mhm.
because the mechanics really matter here. The first, and definitely the biggest category, is fiat collateralized stablecoins. These are the ones you're most likely to run into, the market leaders. Their mechanism is, on the surface, pretty straightforward. They aim for a one-to-one backing with traditional currency like dollars or maybe cash equivalents. These reserves are held by the issuer, ideally in regulated financial institutions.
So for every digital coin, there's meant to be a real dollar sitting in a bank account somewhere.
That's the idea, yeah. Or things like short-term government bonds, very liquid assets. And crucially, these reserves are supposed to be audited regularly to provide transparency and prove the backing actually exists.
Okay. And the big name here, the elephant in the room really, is Tether USDT. Launched way back 2014, was it?
That's right, 2014.
And its market cap is massive now, over $100 billion. And I've seen stats where its daily trading volume sometimes beats Bitcoin and Ethereum combined. Almost $80 billion traded in just 24 hours at one point. It's incredibly liquid, available on tons of blockchains, like over 15.
It is. It has huge network effects. But, and this is a big but, Tether's story gets complicated. Despite being the dominant player, it's been dogged by controversy almost from day one. There are those early questions, remember? Claims it was only, 74% backed by actual dollars at one point, which went against their initial promise of full one-to-one backing.
Right, I remember that. And weren't there also allegations about market manipulation, using unbacked USDT to pump up crypto prices?
Exactly. Those allegations have persisted, and regulators have definitely paid attention. The CFTC fined them $41 million for misrepresentations, and there was that big $18.5 million settlement with the New York Attorney General in 2021. That forced them to provide more detailed transparency reports about their reserves.
It's still kind of amazing it holds on to its top spot with all that baggage. Is it just because it was first? Or is its utility just so powerful that people overlook the risks?
That is the million-dollar question, isn't it? Or maybe the $100 billion question here. It's fascinating and maybe a bit worrying. For a huge chunk of crypto users, especially maybe traders on offshore exchanges or people in countries with high inflation, the immediate usefulness of having a liquid, globally accessible, stable asset just seems to outweigh those concerns about, the exact composition of the reserves or the regulatory issues.
So practical need wins out over ideal transparency.
It often seems that way. It's so deeply embedded in the crypto plumbing now, thanks to being first and getting integrated everywhere. For many, it just works, providing that essential stability and liquidity, even if they aren't fully aware of the controversies. Plus, there's always that lingering fear in the background, the bank run scenario.
Ah, the idea that if everyone tried to redeem their USDT for dollars at once.
Exactly. Could Tether actually meet all those redemptions? A failure there could cause chaos across the entire crypto market. It's a systemic risk concern.
Okay, moving on from Tether then. The other major player in this fiat-backed space is USDcoin, USDC, issued by Circle, backed by big names like Coinbase. Market supply around $33.6 billion, so still significant. And they seem to be really pushing the transparency and regulation angle, right? Positioning themselves as the cleaner alternative.
That's definitely their strategy, yes.
Sure.
USDC makes a big deal about its transparency, and to be fair, they back it up reasonably well.
Yeah.
They claim full backing by highly liquid reserves, and they get monthly attestations, not quite full audits, but attestations from a major accounting firm, Deloitte & Touche, since 2022, I believe.
Okay.
And their reserves aren't just vaguely defined, they're held in specific places. An SEC-registered government money market fund, the Circle Reserve Fund, plus cash at regulated banks. Bank of New York Mellon acts as a custodian. BlackRock helps manage it. That level of detail and institutional involvement is a key differentiator from Tether.
But there's a catch, isn't there? I read something about locking funds.
Yes, that's the caveat. The issuer, Circle, does have the technical ability to freeze or blacklist USDC addresses.
Hmm?
Now, they might do this for legal or regulatory reasons, but for users who prioritize absolute censorship resistance, that's a definite concern. It's a trade-off.
Got it. And quickly, beyond these two giants, you mentioned others emerging. PayPal USD, PYUSD.
Right, PYUSD is interesting, mainly because of PayPal's massive user base, over 400 million potential users getting easy access. That's huge for adoption. And Agora Dollar, AUSD, which seems more targeted towards institutions, needing that sort of institutional-grade custody, it signals where the market might be heading.
Okay, so that covers the fiat-backed category. What's next? You mentioned a more decentralized approach.
Exactly. That brings us to crypto-collateralized stablecoins. These take a different route. Instead of fiat reserves, they're backed by other cryptocurrencies, usually volatile ones like Ethereum.
But wait, if the collateral itself is volatile, how does the stablecoin stay stable?
Great question. The key is over-collateralization. So to mint, say, $100 worth of this kind of stablecoin, you might have to lock up $150, maybe even $200 worth of Ethereum or another crypto asset. That extra value acts as a buffer. If the price of Ethereum drops, there's still enough value locked up to cover the stablecoin's peg.
Okay, so there's a safety margin built in. What happens if the collateral price drops too much, though, below that buffer?
Then the system triggers a liquidation. Your locked collateral gets automatically sold off to pay back the stablecoin debt and maintain the peg for everyone else. It's a core part of the mechanism, but obviously a risk for the borrower.
Right. And the big player in this decentralized space is DAI, is that right? From MakerDAO.
Yes, DAI is the largest and probably the most well-known crypto-collateralized stablecoin. It's part of the wider Maker protocol, which is a big DeFi lending platform, and it's governed by MakerDAO, a decentralized autonomous organization. So token holders get a say in how it runs. DAI uses that over-collateralization model we just talked about to keep its peg to the dollar.
So the appeal here is really about decentralization then, avoiding reliance on a single company like Circle or Tether.
Exactly. If your main priority is avoiding censorship, avoiding reliance on traditional banks, and having a system governed by a community through a DAO, then crypto-collateralized options like DAI are designed for that. They aim for transparency on the blockchain and resistance to being shut down by any single entity. But it's not without its own risks.
Such as?
Well, you have smart contract risk bugs, and the code could potentially be exploited. That's a risk in all of DeFi, really. And governance risk.
And you mentioned another one, LUSD from Liquidity.
Yeah, LUSD is interesting because its protocol is designed to be immutable, meaning the rules were set and can't be changed, not even by DAO.
Yeah.
It allows users to lock up Ethereum at a lower over-collateralization ratio, actually just 110%, to mint LUSD. The benefit is no governance risk, which appeals to some, but the trade-off is generally less liquidity compared to DAI, and the peg might sometimes drift a bit further from $1.
Okay, interesting contrast there. Now, the next category sounds a bit more experimental, maybe even dangerous. Algorithmic stablecoins.
Yes, experimental is one word. High risk is definitely another. Algorithmic stablecoins try to maintain their peg without direct collateral, or maybe with very little. Instead, they rely purely on software algorithms and market incentives. The idea is the protocol automatically adjusts the token supply, minting more if the price is above the peg, burning tokens if it's below, trying to use supply and demand dynamics to steer the price back to $1.
Right. And this is where we get to that cautionary tale you mentioned. Terra USD or UST, that wasn't just interesting, was it? That was a catastrophe.
It really was a painful lesson for the entire industry. May 2022, UST was huge, a multi-billion-dollar algorithmic stablecoin. And it just collapsed, depegged dramatically. And because it was so intertwined with its sister token, LNA, the whole $60 billion Terra ecosystem basically imploded within days. It was brutal.
And that was largely because its stability mechanism was purely algorithmic, relying on arbitrage incentives that just broke down under pressure.
Precisely. When confidence evaporated, the death spiral kicked in, and the algorithm couldn't stop it. It really highlighted the massive risks. These things, despite often clever designs, just haven't proven they can withstand severe market stress. The risk of depegging is incredibly high, the mechanisms are often super complex. Frankly, while new projects keep trying this model, they carry enormous risk. Probably not for the average user.
Understood. Okay, what about synthetic stablecoins? You mentioned this is a newer hybrid category.
Yeah, this is an emerging area, often quite complex. Synthetic stablecoins try to combine elements, often using financial derivatives to maintain their peg. A key example right now is Ethos USD. Their approach involves holding crypto assets, like staked Ether, but simultaneously opening a short futures position for the same asset. It's called a delta hedging strategy.
Okay, break that down. Delta hedging.
So imagine they hold Ethereum. If Ethereum's price goes down, they lose money on the holdings. But they also have a short futures contract betting that Ethereum's price will go down. So they make money on that short position. The gain on the short is designed to offset the loss on the actual holdings, keeping the total value stable or delta neutral. That stable value backs the USDT token.
Okay, one last category, commodity-backed stablecoins.
Yes, fairly straightforward concept here. These are pegged to the value of physical commodities, most commonly gold. Examples would be Tether Gold, XAUT, or Pax Gold, PXG. Each token is supposed to represent ownership of 1 troy ounce of physical gold held in a vault somewhere.
So the appeal is basically getting exposure to gold, but in a digital, easily transferable format.
Exactly. You get exposure to precious metals without needing to physically buy, store, and secure gold bars yourself. And for some investors, it serves as a hedge against inflation or economic uncertainty, just like physical gold might.
That makes sense. So we've covered a lot of ground: fiat-backed, crypto-backed, algorithmic, synthetic, commodity-backed. Quite the spectrum. But it hammers home that point. Even though they're called stablecoins, that doesn't mean zero risk, does it?
Not at all. Stable doesn't mean risk-free. That's crucial to understand.
Even the seemingly safest ones, the fiat collateralized ones, they can still trade slightly off their peg, right? I saw data suggesting that happens quite often, actually.
Yeah, between about 27% and 73% of the time, according to one source, they might trade at a slight discount or premium, usually small deviations, but it impacts things like arbitrage. And as a learner, it's vital to remember, none of these are 100% risk-free. They aren't FDIC insured like a bank deposit.
And there's still that bank run risk we talked about with Tether, potentially affecting any collateralized stablecoin if confidence wavers. Plus, the issue of audits versus attestations still lingers for many, right? That skepticism about whether the reserves are really fully there and appropriately valued.
Absolutely. Attestations are snapshots, not deep dives like a full audit. That difference matters to some people. And overriding all of this is regulatory risk. The rules are still being written in many places, and new regulations could impact any of these models, maybe significantly.
So connecting this to the bigger picture, that explosive growth over $162 billion now obviously hasn't gone unnoticed by regulators worldwide. They're not operating in a gray area anymore, are they?
Definitely not. The regulators are fully engaged now. You see it clearly in Europe with the MiCA framework markets in crypto assets. That kicks in fully, well, it's effective June 30, 2024. It sets really clear rules for stablecoin issuers. Things like holding a significant chunk, 60% of the reserves in European banks, much tougher transparency rules. And notably, MiCA essentially bans purely algorithmic stablecoins, given the UST disaster.
And what about the US? I know things have been slower, more fragmented there.
They have, but there's movement. The proposed Genius Act is one example. It aims to define payment stablecoins specifically as a form of digital money, not as investments or securities. And it would mandate things we've discussed: full one-to-one reserve backing, regular audits, strong consumer protections. Getting this kind of regulatory clarity is seen as absolutely crucial, especially for getting big institutions comfortable using stablecoins. One survey showed 88% of North American firms see clear rules as a green light, not a hurdle.
That makes sense. And what about other market trends? Where is this heading?
Well, investor confidence seems incredibly high, despite the risks. That projection of funding for stablecoin companies hitting $12.3 billion in 2025, that's more than 10 times the 2024 figure. That's serious capital flowing in. We're also seeing real integration with traditional finance. Major players like MasterCard are actively enabling stablecoins like USDC and PYUSD on their networks. That's bridging the old and new financial worlds.
So making them easier to actually use for payment.
Exactly. And the other big push is cross-chain innovation, making it seamless to move stablecoins between different blockchains, Ethereum, Solana, Avalanche, etc. That interoperability is key to making the whole ecosystem smoother and more user-friendly.